If you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. If you enjoy the video, please smash the like button for the YouTube algorithm. And as always, just let me know down in the comments below exactly what you would like me to cover in my next video. Now, we had a question from a gentleman before we dive into this Euro USD breakdown. He asked why the market opened with such massive gaps on Monday this morning. Well, it's quite simple. So, Mr. Putin over there had he has put his nuclear troops on high alert. Um, so when stuff like that happens, investors tend to get scared. So they do what's known as a panic sell, and investors close that they sell their portfolio stocks way before the market opens, and then as the market opens, then you get a massive liquidity. Well, sorry, you get a massive gap in the market. So that gaps you saw in the market was just investors selling and running and going back and investing into safe havens. Once again, that's why there was a positive gap on gold, a positive gap on oil, negative gap on the stocks, because that is what causes panic selling. They're the same like us. So if you think of it in this way, before you invest into any business, you want to make sure that things are going right and it's profitable. Well, they know as Ukraine affects, as Russia and Ukraine starts this whole war, that's going to impact stock prices, because the Nasdaq, the Dow Jones, as well as the S&P 500, they accumulate profits through consumer spending right across the world. So if they start a war, then that supply is cut off from Ukraine and Russia. So investors tend to just sell the stocks and go and invest their money into things like gold and Japanese yen as well. Now, if that answered your question, so today we're going to take a look at the Euro USD from a technical, fundamental, and order flow perspective, and look for the best probability to trade this market. I'm also going to give you guys a nice little website that you can go and look at, maybe study it on your own time towards the end of the video. It's got some very good content that I got from a guy yesterday as well. So we're going to start with the technical data. I can tell you guys right away that this market's going to fall down all the way to and go and test that level of support. And I'm going to explain to you exactly why I say that just by looking at the technical data. So in any case, let's go. So starting on the monthly time frame, what do we have? Firstly, we can see how the market had broken below that level of resistance, came to test it, that level of support, and it's now testing it as resistance as well, giving us an indication that we can expect that meltdown to the downside to continue. Also here on the monthly time frame, we can see how the market printed this massive impulse and correction, giving us an indication that we can expect a continuation to the downside from a technical perspective. Taking off Fibonacci from the high to the low, we had a rejection at the 0.382, which gives us an indication that the downward momentum is quite expected. Also, we can see how the minus 27 is lining up perfectly with that previous level of support, so we can expect the market to go and test that level. Now we're going to use that as a target level for us in the market. Now here on the weekly time frame, it came as no surprise that the market had opened with these gaps, and we know that as well. But the market is still trading below the structural level that it last created. This level over here acted as a level of resistance. Market broke above that, then came to test it as support. Support did not hold, and the market's now trading back below that. So we can expect the market to pull back slightly before the continuation to the upside. In fact, no, there's no pullback. Sorry, as class, no, there's no pullback. It's just down from here. The reason why I say that is this level over here acted as a level of support for this consolidation phase that the market had broken out. All of the support is now being tested as resistance, and we can see how the market is rejecting that level quite aggressively there as well. They're giving us a further indication that we can expect this meltdown to the downside to actually take place. Now here from a daily perspective, now firstly I spoke about this information that the market had created. The market went to test it at the neckline as well, completing that information. After the information, like you guys know, you expect a pullback to the neckline before the continuation to the downside as well. Now we've identified this take profit level over here. Now there's two ways that you can go about taking this trade. If you are a very aggressive trader, or you're the kind of guy that cannot wait, then you're more than happy to start looking for selling opportunities from where the market is now. Now as always, we want to make sure that you get into the best we want to make sure that we get into the market with a good entry. So the best way I would say to approach the situation is to wait for the market to break up. Oh no. I would say for you to approach this market is to wait for a clear break below this level of support. after that, all of that support would be then turn the resistance. So you can on the retest start looking for selling opportunities on here as well. Now, next thing we're going to go is we're going to look at the PMI data that we are getting released tomorrow. Firstly, the previous was 57.6 for, and the forecast is 58. Now, if you don't know, the ISM manufacturing data is basically export and import goods that are measured. So a lot of companies, they provide data on how much goods and goods were sold, like how much stuff actually was sold and how much stuff actually came into the country as well. So it's got a lot to do with with profit margins as well. But anything above 50 is good. Anything below, I think 40, I'm not 100% sure, but anything below 50, anything above 50 is good for an economy. Anything below 50 is not considered good for a country as well. But we can see that the US PMI was doing quite well. We went from 55.8 last month. We got 55.4. The forecast for this month is higher than the previous month as well. And I'm quite confident that we can expect a positive PMI, because we had a lot of positive data for the US dollar in the previous month that's still carrying over into this month as well. Next we got here, this is the PMI data as we just spoken about now. So we can see how the PMI was very consistent in terms of staying above the 50%. So like I said, as long as uh, the PMI stays above 50%, that should be considered good for the economy as well. Apart from that, we do have a lot of US dollar news coming up this week as well that we can probably expect to be good also. But if there's one thing I want you guys to learn about this is that, it doesn't matter what high impact news we are going to get this week, the markets are still going to move purely based off the invasion of Russia and Ukraine. Like a lot of the movement's gonna come from there. We might not even see the market react too much to this fundamental data, because that is like the main event. Okay, by now you should have been able to see what that event does to investors. That is kind of like the massive main event that people are watching as well. But you have to still take this data into consideration as well. Now, if you're going to look at the euro also, this is the reason why I say that the euro is doing quite bad at the moment, because if you look at the euro annual inflation and its main components between January 2012 and January 2020, um, it, it's it's just very clear to see. You can see where this inflation's sitting. It's sitting almost like this is, it's so high. And the problem with the guys in that exchanges in the euro is that they don't want to hike interest rates to tackle this inflation, because they've been keeping inflation steadily at zero for quite some time as well. Now, don't get me wrong, there's a there's an advantage and there's a disadvantage to having high inflation. Now, some of the good things about having high inflation is obviously moderate inflation also enables economic growth. Inflation also allows adjustment to real wages. It means that people get increases. It also help with the adjustment of prices, and sometimes inflation is better than deflation, but it can also cause a recession, and you want to stay away from that also. But the bad side about having inflation is it creates uncertainty and lower investment. Now, if nobody wants to invest in your business or in your currency, it's not going to increase in value. Also, high inflation leads to lower growth and less stability. That also reduces international competition, because we know Powell's gonna hike those interest rates next month, hopefully, depending on the data that we get this week. So the euro's not even competition, because why? Look at that inflation and go look at their interest rate at the moment as well. Next up, also at fall, there's a massive dip in the value of people's savings, because high inflation tend to mean lower interest rate. And also, if wages don't keep up, then that also means that the actual real wages comes through lower as well. So next up, we're going to look at the sentiment data. Now, if you look at the sentiment data, this tells us what retail traders are doing. I hope you understand why I said the euro is gonna just dump. That's it. Like, if you want to disagree with me, that's okay. But I've told you now exactly why I say so. The dollar index is very strong at the moment. So the sentiment data tells us what retail traders are doing in the market, and as you can see, 42% of retail traders are selling, and 58% of them are buying. And the one thing you know, if you've been with me for a long time, I always say that you want to be on the opposite side of what retail traders are doing in the market as well. Now, the next thing that we are going to do, so if they're buying, we want to make sure that we want to get in there and selling. The next thing we're going to do is look at the COT data. So this is the commitment of traders. And this tells us exactly what the big banks, hedge funds, and institutions are doing in the market. Now, these people are people just like myself and you. So don't think that they are also like they are the bar, they are the, the like the big guns out there. I can see a base of last week's report. They actually closed minus 3,704 longs, and they also closed 15,000 shorts. Now, if you see the report bring out negative data for a buy and a sell, all you have to do is look at the overall net positions. Now, firstly, this report was released last week, as you can see there, the 22nd of February. Net positions increased from 47,000 to 59,000. And you can obviously see that from a technical perspective because the euro was quite bullish for some of last week as well. We had that massive dip that came through, but the euro closed bullish, completing that information as anticipated there as well. So that is a full breakdown on the euro USD and why you can expect this market to take a dump. First, I want to say thank you for your time. Um, and if you enjoyed the video, please smash the like button for the YouTube algorithm. And as always, cheers for years.